It's 2 p.m. in Geneva, and we start our today's masterclass dedicated to proactive credit control. Uh, Today, there will be no presentations, no bullet points, no charts, nothing. We will be only speaking about the role of credit control within the whole credit management process and how significant this role could be, despite the fact that in many cases this role is not that clearly seen. I hope, as usual, I will do everything and I will try my best to finish and to share everything I wanted to share with you within the nearest hour. And then I will be happy to answer your questions. So please continue to ask them in comments. Continue to comment. If you like it, please like. If you dislike, put your negative or critical comments. They are also appreciated. And if you find it possible, I will be very grateful if you can reshare this event with your colleagues and with your peers, so as many people as they might be interested to see it will have a chance to see. And let's get started. In holistic credit management, we consider the whole process of credit management as three main stages. First one includes credit structuring, which in essence means it answers the question which terms we can offer to our customer. Then we get to the control stage and we answer the question, what should we do or how should we behave if our terms, whatever ideal, whatever perfect, whatever adequate they are, do not work. And then on later stage, on the third stage, we start to do something in order to collect our money and to recover our money back to the company. These are three different stages, and today we will be speaking on the middle one, so about credit control. In most part of my discussions, unfortunately I don't have that big representative selection of cases, so I'm not pretending I have really the ultimate truth in my head or in my possession, but in the significant part of cases of discussions with companies, with businesses, I find that many people believe that credit control is a simple thing as dealing with orders on hold. Or, I mean, if you wish, as one of sales directors I was working with said, no money, no honey. So if customer paid, we ship goods or we continue to render services. If customer didn't pay, we stop doing so, and this is it. So there is any intellectual involvement into the credit control. My answer is pretty simple. If you can afford it, please do. Like in my favorite cartoon, if you have a dragon, you should not be afraid to use it unless this does not damage your business. Because if you can afford not to ship goods if customer doesn't pay, please do so. If you can afford ban every single shipment if the credit limit is just exceeded, and without doing anything. Like, your credit limit, you knew your credit limit when we were signing the contract. Now you are above. What do you want? What order do you want us to proceed with? If you can afford such a policy, this means that with a very high probability, this means that you are in what is called exclusive credit, where you are in position to choose your customers. And don't hesitate to use your luck properly. However, majority of companies, again based on my observation, do not have such a luxury. and refuse to ship goods to a customer or rendering services might be a gift to their competitors. And then we are getting to the stage where we need to think. And my research, my experience shows that this is the destiny of the vast majority of companies. We cannot simply, most part of companies cannot simply say, no money, no goods. That's okay. But that's the situation, and we have to deal with this, we like it or not. And furthermore, if you are in that exclusive situation where you can simply ban shipments or simply don't work with the customer because they don't pay, for that you don't need any credit control. You don't need anybody to deal with that, because that job can be easily done by any, even accounting software. I'm not even mentioning ERP. It's like every single piece of software which is dedicated for business processing can do that. No money in the system, no free credit limit, existence of overdue payment, we don't ship. But in reality, for the bigger part of businesses, for the bigger part of companies, this does not work. We have to be flexible. And this turns our credit control stage into really a decision-making, at the decision-making stage. So it is as decision-making as structuring. On the first stage, we decided what term we would use to deal with the customer. What would be the credit limit? What would be the payment term? What would be the requirement of trade credit security, if any? Maybe sometimes maybe discounts, sometimes maybe something else, covenants like in banking system. However, sooner or later, these terms stop working. There will be excess of credit limit, there will be overdue payment, and each time we understand that if customer doesn't pay, if the credit limit is exceeded, we need to decide what we're going to be doing, because we are not in that black and white situation anymore. And here there are several ways to do that. I mean, when we understand that our terms, our credit terms do not work, there are at least three possible options. And we are at decision-making stage. We understand that we can either insist on our terms. So like we know that customer who comes with order is just abusing our terms, or they try to take advantage of the situation. In that case, we simply say, okay, you've signed the contract. I mean, we can repeat everything I said above just to save our time, and simply insist on our terms. Second, more dramatic option. We understand that since the situation is changing, since the conditions under which we were choosing our terms, or we aligned our terms with the customer, already changed, we might need to consider to change our credit terms. So we need to reconsider that. We need to find another payment term. We need to redefine our credit limit, security requirement, and maybe something else. But the situation could be also somewhere in between. The situation could be where we understand that, yes, there is a change in condition, but this change is temporary. For that, there might be no need to change term, to review the term completely. We might do that either partially or for the limited period of time, which technically mean we provide our counterpart or our customer with an exception. This is also a decision. And I mean, exception management, we will touch in another story, in another issue, because today our job is to observe what are the components of what is called proactive credit control. So, and what can we do in credit control in order to make our credit management more efficient, more helpful to business, more customer oriented, if you want. On the other side, we understand that mere letting customer get our goods and letting our customer getting our goods and services is not really a solution. One side, if, for instance, if we are in a competitive environment, we cannot afford simply not to ban shipments or rendering services, but at the same time, simply letting them go is as bad solution as previous one. So we need to find the balance. One of the best quotes I found was written in Credit Management Handbook. If I'm not mistaken, please correct me if I'm wrong in comments. It was said by Glenn Bullivant. So if customer continues to receive goods and services despite their credit limit excesses and overdue payments, this means that there is no credit management within the company. Or if credit management has no power to ban shipments or to stop shipments or to restrict them, then their capacity to perform credit management is significantly restricted. So, first thing we need to make, and this is important, we need to set up a system which prevents counterparts to receiving what they used to receive in case they deviate from the payment term. This does not mean that we will never ship or we will stop ship completely, but we as a company, we as a management, and we are as a credit management are informed about that deviation from payment term. Credit limit excess. Generally, we've got three: credit limit excess, we've got overdue payment, and we've got expiration of trade credit security. We can speak about that. If you win, please mark that in the comments. So we need to set up that somehow in the system, and normally the best way to do that, and this is the first stage of the control, where the customer sales order is checked versus current situation of a customer on their account. We may discuss that in detail, again, put that into question, but I try to be brief. This is the first line of the control. The operator on the warehouse, if we ship goods to a customer, tries to set an order in the system, and the order gets blocked because of overdue, because of credit limit excess, and then we decide what we need to do about that. So then we need to consider that order on hold. The same story with overdue. The same story, if you got quite advanced system, would be with trade credit security. For example, let's use bank guarantee as example. When the sales order is to be blocked, when, for instance, the bank in certain period of time before the bank guarantee expiration or after the expiration date of the bank guarantee, because credit limit has been given on condition of bank guarantee provision. This is first stage where we understand that, okay, we are informed that this situation has been happening. There is also post-control, which we normally can see as reported. The control could happen post-factum, when we can see what's going on with our receivables. And by the way, credit control stage is not only a decision-making. It's also the first stage where we actually start to look at our receivables not only as a complete transaction with the customer, but a portfolio of receivables. And here we can look at reporting. And reporting gives us a chance and gives us an ability to see, first of all, our overdue payments and also our credit limit excesses. With 90 something percent probability, all credit report, what we call receivables reporting and so on and so forth, is actually using fine old aging report. But there are several, let's say, extensions which could be used to it. First of all, good aging report will include balance, current balance, then, you all know 16, 30, 60, 90, 90 plus, or this could be any number you believe is correct in your business, which is absolutely great. But plus to that, we can put their credit limit, we can put their trade credit amount and trade credit security, we can put their credit limit excess. And if we highlight them with red, we can see how many excesses do we have. So how many exemptions did we give, if we gave them? Or they just happen because we don't control our receivables. This is, again, good sign for us to get back and to reconsider what's going on in this or that specific case. The same story with overdue. And my experience shown that quite recently, I've seen a publication which says that how many reports about receivables CFO needs. And there was a list of 5 or 7 different reports. I was really surprised if any of CFOs, and if any of you who is listening or will be watching it in record, if you got your CFO, finance director, finance manager capacity, please mark in comments how many reports you need to understand receivables, because my understanding, I will put here in today, but in general, 1 report per day, which combines the whole situation about accounts receivable, is more than enough for the CFO. Weekly reporting might be useful, again. It's if it is will of a specific manager, and or a CFO or higher management, and then agent report in the end of the month. Normally, it was in my experience, was just sent to the headquarter for the consolidation purpose, because our daily credit report was much more detailed. And in that report, you can show reasonably anything. So based on agent report, you can show total credit limit excess, total overdue, if you wish to calculate DSO or true DSO or whatever ratio you believe it is necessary to be an interface between credit function and finance function, or maybe any other stakeholder. It's okay. The idea of reporting is to provide the user of that report with the view of current situation of receivables. It's very far from being portfolio analysis, which we will be discussing later today. But in general, 1 report sent to everybody of the same format saves a lot of time for everyone. And normally it's just like distribution list to everyone who is interested about accounts receivable situation up to date. One important remark: if you do like 1 shipment per month and the situation with receivables does not change on daily basis, maybe even weekly report or like monthly report will be absolutely enough. Again, not to spam, information space within the company, just with all that, fresh data. But again, very good. It's good practice when the credit team sends one report per day, which is usually enough, and could be quite helpful. But this is just a recommendation. We said 1, 2, then that very, very classical task or component of credit control is usually establishment of bad debts provision. To a certain extent, this could also be done during the structure. Thanks to IFRS 9, we can book provision just when we understand how much risk we take with the customer, so we can provide the potential bad debts in advance. But generally, we look at our portfolio, although this derives from the prudency concept of accounting, and this is our line of cooperation between credit management and accounting, one of them. But bad debts provision is an instrument for us, first of all, to provide for the debts we might write off. And plus to that, thanks to the new standards, we got a chance to hedge our potential losses, because our potential losses due to the risk, which might happen due to the risk we as a company take. So instead of just provide, like, very simplistic, I would say primitive approach to bad debts provision is to provide everything which is in areas for more than 90 days. And this might be okay if you are in banking business, because there is regulatory requirement. But when we get to the non-financial, so where we got to the real sector of the economy, there is no such a requirement. Most part of accounting standards, I'm happy to see your corrections if you have any, say that there is the probability of non-collection must be above 50%, so we can provide for that. There might be situations, and I've seen them in my own life, in my own professional cases, where outstanding or certain debts were in areas for 90 days, sometimes for more than 90 days. And at the same time, they were still considered collectible. Well, simplest example, imagine a debt which is covered by the bank guarantee. Yes, obviously, we can use that bank guarantee any single moment of time, but there is future business. We need to take into account also the future cooperation with the customer. Yes, we can, but if we are ready to cut the all future business, we should do that without any hesitation. But at the same time, the debt is overdue for more than 90 days, but it is still collectible. Why should we provide for that? So bad debts provision and the whole concept, again, that is a part of credit control, and it is very important part of this stage, where we, as credit managers, as credit function, can apply certain control measures, control metrics. And also, as I mentioned, if the situation with customers change, for instance, we've given credit, we've granted credit limit to a customer with a certain level of credit worthiness, and then with the certain period of time, we understand that their credit worthiness has been degraded. What should we do? Obviously, we will negotiate with the customer. We will speak with them. What are their perspectives? How do they plan to recover, and so on and so forth. But for that certain period of time, until they are really recovered, we may increase our bad debts provision just because we are taking higher risk. And as you can see, this is quite complicated, and I would say extremely creative, and although creative accounting might sound negative, but this is really a creative and important part of job, and it is intellectual. It is intellectual, so we need to consider what we do. We need to review our portfolio, and we need to understand what can we do with the risk we take. Because risk we take in our receivables might bring our company to the edge of bankruptcy if we don't control it. And this is still credit control. This is much, as you can see already, this is very much different from simplistic understanding, no money, no honey. No, it is much more than that. Now let us get to the not really hot water, but a bit heated water, because in a bit controversial situation, because here we are touching to the stage where we need to also have a look at our performance. Today, as usual, I am not very big fan of discussing what is the proper DSO formula. Those who are with us and who are attending our events, they might know that I am big fan of performing credit management without DSO due to A, B, C, D, X, Y, Z reasons. However, let's consider the performance metrics. You see, there are big group of people. There is big group of people who believe that every sub-process within the business could be explained and clarified with one KPI. Let's not touch. Imagine this is not a DSO. Let's use DSO as example. With all of the criticism we are speaking about, if we know only the DSO if we just track if the DSO is the only KPI, is the only metric we track about accounts receivable, we are in a difficult situation, because we cannot explain receivables portfolio with DSO only. Let me give you an example. When we analyze our customer, we obviously calculate DSO, we got sales, we got receivables, and we try to understand what is the, let's say, average collection period, although DSO does not give quite precise idea about that. But when we look externally, when we look at financial statements, this is quite clear. We don't have other data. However, when we are within the company and when we not really only see that performance of receivables, but we try to improve it, we're supposed to use much more many metrics. Because if you, I'm recalling my discussions with auditors, can you please explain DSO variance? Very good. But in order to explain DSO variance, we need to calculate at least standard DSO. We need to calculate best possible DSO. We need to calculate the DSO, the delinquent debt sales outstanding. So even if we use that primitive measure of DSO, we need another 3 measures to explain the portfolio. But then somebody like as picky as myself would say, but DSO says nothing about credit risk we take. DSO has nothing to do with bad debts. DSO has nothing to do with sales performance, and we know that receivables exist to support sales, so DSO cannot measure that, and so on and so forth. So when we speak about performance measurement of the portfolio, there is an interesting idea, and being implemented, it shows, based on my experience, quite good results. Instead of creating tens of metrics for accounts receivable, knowing, by the way, that all these metrics will be business specific or industry specific or something like that. Instead of that, or in parallel to doing that, we need to perform portfolio analytics. We need to do a portfolio review. If you let me generalize, the portfolio review is as important as, is even more important than credit policy, because properly done portfolio review process, which includes all the different views of the portfolio, like portfolio exposure, like portfolio performance in terms of sales, portfolio performance in terms of overdue and in terms of payments. Portfolio review or portfolio reporting is much more wider process, which provides first of all credit function itself, then our peers or our stakeholders in sales and in marketing, in general management, in finance, in treasury, very often in accounting. If you have any other, like, tax or customer service, this is very helpful, because we can really have a look at what are our objectives, where we got our portfolio now, what risk we take, how much we spend in order to support our portfolio, and many other things. In portfolio reporting, we can include everything. But what is important is that we need to perform that portfolio review on regular basis. Obviously, not every day. I think even every month would be too much. Once a quarter, once half a year. Obviously, we need to turn that into historical perspective, so we can see trends. Everyone who does credit analysis, everyone who does, even with metrics, we don't just calculate any metric like DSO or true DSO, which I'd prefer, on daily basis. On daily basis, it's the job of others. We need to see the real, but we need to see the trend over the 12 months. We see, where do we go? What is the trend? And what do we do in order to make it better? So this everything could be done in the portfolio review, where you invite your stakeholders and you share with them this information, and they know what is going on. And in the portfolio review, you can see the areas for the improvement of the portfolio. And it is much more helpful. It is much more helpful because you take holistic view on the portfolio. And in general, if we look at credit management as a holistic process, it's one of the 3 degrees of wholeness or integrity of credit management function. It's a process of constant improvement and adaptation of receivables portfolio to the needs of a business. Needs of business are changing every day. Therefore, we need to adapt our portfolio. And therefore, we need to review it, and we need to take that comprehensive, clear view on the portfolio. And this is, again, a stage of a credit control. And trust me, portfolio analysis is one of the most interesting, the most complicated task in credit management. So if you really like, to challenge your mind, to challenge your professional skills, portfolio analytics, portfolio review is a great task to make you as great as you believe, or as you wish in credit management. And for those who, if you are a credit analyst, and if you are a credit manager, if you are head of credit, dispute me. I would be happy to hear your constructive critique, but head of credit is the person responsible for the portfolio. Therefore, we need to make portfolio, comprehensive portfolio view, comprehensive portfolio reporting to see that and then decide what to do. And this is still much more important than just no money, no honey. So look at one more argument to portfolio reviews and to portfolio process. I found, observing the process, how the companies are implementing their credit management. So very often companies start their business. They provide customers with credit terms because they have to. Then they understand that customers don't pay them, and it's just the right time to implement credit management. So they understand that sometimes they lose. They already managed to lose, a certain amount of money. Sometimes their overdue is too big, and so on and so forth. And this overdue might be as big, is big enough to affect their ability to pay their suppliers, and so on and so forth. So then, what normally companies start to do first? They start to collect overdue. After a certain period of time of collecting overdue, they understand that, mere collection of overdue is an endless job, because we collected, we managed to convince customer or counterpart to pay us, and then next payment falls due, and it becomes overdue again and again and again. So we need to control. So when we started with collection, we understand that this job will be endless until we implement control. Now then we start control. Control is good thing, it is important thing, but as in the very beginning, in my first attempts in my consulting career, one of the business owner told me, I can make my receivables perfect tomorrow, right tomorrow, with no help from anyone. The only problem is how much sales it will cost me. So how much sales, what part of volume I would lose. Because if I would be too strict, my receivables would get better, but I would start losing sales. Then we get to understanding that, obviously, if it is not obvious for you, again, challenge me. You might have your own arguments, but my firm convincement, my firm understanding is that improvement of receivables at cost of sales is one of the most stupid things business could do. So we understand that, we cannot improve receivables at cost of sales. Therefore, control must be flexible enough. And if the terms we put in place when we deal with our customers are incorrect or inadequate, or became inadequate due to changes in the market, control won't be effective, because control is really that that narrow line between sales and finance, or between cash flow and volume. If we go too much to the right, or too much to the left, we are losing. Therefore, we understand that we need to take care of adequacy of our credit terms. So company starts to implement that view on credit risk assessment, optimal terms of credit, and everything which we might call the simple in one word, in structuring. Then we structure, then we start to do portfolio report, and then we come to the stage, okay, why don't we have, like many years ago, my CFO, one of the best CFOs I worked for, asked me. I came to him with the request for credit limit for his approval, and he said, does this new credit limit increase our our risk exposure? I said yes. Then he asked me how much risk we take now. Then I understood that, okay, I need to find an answer. I need to look at the portfolio as a whole. And then, piece by piece, many companies get that when they implement credit management software. Some other companies implement their portfolio reporting. And by the way, portfolio reporting we do in credit engineering. If you need it, let me know. So when the company looks at, first time they look at their portfolio, they understand that if they start that job not from collection but from portfolio analysis, they will reach to the result they get in the end 2 times faster at least, and 2 times cheaper, 2 times less expensive, just because portfolio gives that real clear picture of what are the areas for improvement, what can we do. And by the way, portfolio review and portfolio analytics gives an enormous help, tremendous help, when the company needs to review their credit policy or when they need to establish new credit policy. So it starts with portfolio analysis, and this is really an important stage. And when we speak about measurements, there is one more quite interesting task. Two more quite interesting tasks. One of them is actually getting to the, still stays in the restructuring, but you might know that normally how we take a credit decision. We compare two parameters. We compare credit demand, or how much credit we need to give to customer or to customers for to achieve our goals or for the transaction to happen. Whatever poetically or lyrically I explain that, you all know that task because we all do that, or you all do that. We take sales, or we take sales focused, then we use our credit term, we using either DSO formula or something more calculated. We focused receivables. And if you cooperate properly with in our cooperation with FP&A team, normally FP&A team is asking us credit managers to focus receivables. And this is the same story could be done on the level of individual customer. When we know that there is new sales focused, we can calculate how much receivables we need for this customer in order to continue to do business with them. And with that, we compare that with our current credit limit. And this makes a dramatic change to the way we do credit control, because you see, if we start thinking about that when the sales order is blocked, this might be already too late, or we are already in an extremely difficult situation, because what does that mean, blocked sales order? Very often this is already the truck or any other vehicle who came to our warehouse, who came to our premises to be loaded and deliver goods to a customer. This vehicle is standing just because the sales order blocked, and we all will try to find a solution in an extremely short time frame. We are not proactive, we are reactive. So when we just react, I've seen many people who are doing that job, and I used to do that myself. So that's why I am. So I used to be in that situation, in that status where telephone is ringing every 5 seconds, and you need to find solution. And if you continue to be trying to find solution in that 5 seconds or 5 minutes time frame, this would never be effective, because we are doing reactive job. If we do proactive job, we just say, okay, we need our colleagues either from marketing or from FP&A or from sales. If there is a different focus, especially if the focus is increased, we need to recalculate that in what we call credit demand. This is credit demand. or demand for credit, how much credit we need. And then we compare that with the current credit limit. And this use of that sales forecast recalculated into the future receivables helps us to foresee potential issues with customer. So yes, there might be credit limit excess in the future time, but we have time to resolve it. And we've got much more bigger range of options to solve this issue before it happens. This reduces orders on hold, this improves customer service, and this, you would be surprised, significantly or even dramatically improves our cooperation with sales teams. As simple as that, and this is still credit control. Again, by the way, this is one of the best examples of how credit control could be preventive or proactive, whatever term you would prefer. The last but not least is also on the credit control stage, on the stage of the control, and mixed, or as a part maybe, if you prefer that, as a part of performance measurement is, call it metric. Anash, thank you very much for the comment. I will answer in the Q&A session, so it will be in 5 minutes. I nearly finished. When we speak about measures, and performance measurement is an extremely interesting thing. The Credit Research Foundation did once a research, and they found some 70 different metrics for credit management, from payment DS. I think there are like 10 different DSOs there. Then collection effectiveness, and so on and so forth. But when we have a look at the real needs of business, every business, and when we look with the eyes of a business or a businessman at the credit function, we understand that there are actually 4 needs of a business, or four requirements of business from a credit function: minimum or zero bad debts, minimum or zero overdue, minimum or zero lost sales. And what is important, if you look at this seriously, you will understand that even these 3 things, whatever challenging they sound like, could be easily achieved, could be quite easily achieved. But if they just achieved in any possible way, this will be too expensive for the company. Credit function, every credit function, every credit is an expense for the business, you like it or not. I can tell you that my favorite saying is that credit charges its price on creditors, regardless their willingness to pay. Whatever company underspends on credit function, like setting a credit team of 1 person instead of 10 when 5 are required, but the company they'll spend later on bad debts and overdue and lost customers. So one of the most intellectual and most business-specific, if you wish, approach is to calculate comprehensive cost of credit, which has 7 elements, but we can divide them into 2 general groups. So first, are the results. First group contains results where we can calculate what are our bad debts write-offs, what is our cost of overdue, depending on our financing rate and everything. Then what is our cost of lost customers, because we understand that if the customer has been lost, a customer departed due to our credit policy, or because we were analyzing them for too long, or because we refused to ship goods to them due to whatever technical overdue, whatever it is, we need to find another customer, and this will be cost to us. This is one side of the story. Another part of expenses on the other part of the scale are actually the money we spend on credit personnel, on trade credit security, on credit services, different ones, from credit reports, consultants, trainings, whatever. And altogether, we understand that when we look at this in the historical perspective, we may see that sometimes companies overspend on their credit function, they don't get results they want. Simplest example, I've seen quite number of companies who gave up trade credit security because the cost of trade credit security was exceeding the bad debts write-offs they will incur if they didn't have any security at all, like insurance premiums. It's still a question of discussion. There is no black and white here. Yeah? It's a question whether or not the company decides to take risk or not to take risk. But we have a look at the spending of a business and how we can optimize them. Another story already mentioned. When you got one credit controller who is taking care of the quite big and numerous in terms of customers portfolio, how can you be surprised that this person is not able to do all the credit job in alone with all the possibilities of automation? I don't say this is impossible. I do believe that if tasks are distributed properly, this could be one credit person especially with all the modern developments in technology and everything. But this credit function is to be organized properly. Neither credit function is is just like sitting. Neither credit function should be built like it is done by specified credit department. Company could have no credit manager at all. So reasonably, every credit function in any company in the world is distributed. Another confirmation to that, segregation of duty rules. So payment allocation could not be done by the person who is releasing sales orders or sets credit limits. Therefore, payment allocation by default is delegated, is distributed, is given to somebody else to be independent, whatever I like it or not. It's a question of service level agreement and everything. So this is seventh, one of the most advanced, as far as I can see, part of the credit control. But comprehensive cost of credit is not the thing which is like financial ratio. Sorry. You see, that's truth. Comprehensive cost of credit, like a portfolio review, is not about giving us ready-made answers. It's a tool which helps us to answer better questions. And in general, if we come back to what credit control is about asking questions whether or not our portfolio is performing as business needs, whether or not our portfolio supports sales as it should. and so on and so forth. And depending on the company strategy, depending on your type of business, depending on your current stage of business, on your current situation, credit control, when it is done proactively and when it is done with the necessary level of sophistication, is an extremely powerful tool which helps us to improve our credit function and to make it as useful as business as it should be. Uh, I am done with my today's presentation. So let me see if we have any questions. I see the one from Anash, which I will answer. And please feel free to ask your questions in comments. And thank you very much for your likes, and thank you very much for your comments. Okay, let me start from Anash. What tools shall we use to be proactive credit controllers? Anash, first, I mean, if you want me to give you a big comprehensive answer, I will invite everyone for Deep CM, which you already did. You already got that qualification. But the simplest thing, start with credit demand. Credit demand is an extremely powerful thing because, and for that you don't need any I don't know, any sort of automation tool or instrument. You got sales focused from your sales. You use a bit of your creativity and math, and you immediately got a result. You immediately got that view because you don't need to be Einstein or you don't need to be, extremely intellectual. You just recalculate. Sales into forecasted receivables, compare them with the credit limit. You write one email to your salespeople and say, "Can we discuss what we're going to be doing about that? What do you think we can do that? Or let's discuss what can we do about that." And this makes our operations and our operations with customer extremely smooth, because we don't have block sales orders. We have less block sales orders, and we got better customer service. And you calculate these benefits yourself. I don't want to try to be too much convincing or say too many words. We also got more time to get to customer and speak with that. Another tool which I found extremely useful is, again, portfolio review. For the first time it is extremely time consuming, but then you prepare that, and you can also involve third party. You can involve consultants like us. We do portfolio analysis on outsourced basis, because sometimes people don't have expertise. Sometimes the companies do not have technical capacity. Sometimes they simply don't have time, working time of their employees. And we just prepare, because the portfolio analysis is not a number of tables. One necessary thing I need to say about that is that it's not like creating all these tables or advanced portfolio report. It's creation of views. So our final product is not an Excel or whatever table. Our final product is a presentation which highlights potential areas for improvement of the receivables portfolio of a specific company. Then you go to your peers, you go to your stakeholder, and you discuss what are the possible solutions, what can we do about this and about that. And it's not like I don't say this is like technology tool, it's organizational tool. When you start the dialogue with stakeholders about your portfolio, you will see that step by step you have less and less issues to discuss. And preferably all these issues are moving from the past, from what happened to past. It goes to the future. This means that you are getting more and more and more and more proactive because you deal with issues which might happen in the future. So you're not wasting your time for the time and strength and all your efforts for that firefight. How can we collect overdue? How can we do this? How can we do that? Because, here is burning, here is, frying and everything. No, you look into the future and say, okay, there might be an issue with this credit limit, or there is a deterioration with deterioration of credit worthiness of this customer. What should we do about that? Because worst way to deal that, to do something on your own and then try to sell it to your stakeholders. No, let's make it transparent. Let's involve our stakeholders into the credit management process and let them take their part. Share this I don't say responsibility, but share this view with them. And this will help us. By the way, this is the simplest way to eliminate the conflict between sales and finance. Because you see, normally how it happens, if the customer is in the center, there is finance team or credit team who looks at them from financial side, and then there is sales side who look at them from the volume side. But we are not two parts of the business. We are two parts of the same business. Instead of looking from two different sides and then fight which side should prevail, we need to look at the same issue from the same side. We should not take that extremely different views. We just get together to see and look at that customer, because this is not the customer of sales or finance. This is the customer of a company. And if we work together in order to deal with them properly, we got much more better results, both in terms of sales and in terms of cash flow. Anash, if you have further questions, please ask. So I just give some examples. There are much more different tools. There could be tools which I don't know, but if you try to be proactive, you will see, you will find them, and I hope you will share with me as well. For the new clients, what's the best practice of credit review to do to set the credit limit, and what are the most components documents you need to have? Sadiq, there is okay, let me start from the simple view, because that's what we call structuring. It is trade credit structuring is that's what we called an inevitable task, because companies, there are many examples of businesses around the globe who skip that structuring. They simply follow the request from customer, they give credit limit as required by sales, and they go. But this is still structuring. However, if we want to make sure that our terms of credit are adequate, and this what I always insist on this definition, that credit terms should not be ideal. They must be adequate to our business. They must be adequate to the business of our customer and adequate to the market. A simple example. Imagine there is a market where similar goods, similar to yours, are sold with the credit terms between 30 and 40 days. Can you come, if you come to this market with 90 days, you will be extremely aggressive in terms of financing. Yeah, and this will be unusual, and you would need you would need enormous, significantly bigger resources, because 90 days credit term requires much more bigger receivables, which means much more bigger credit exposure, and so on and so forth. At the same time, and this will be the 90 days won't be seen as adequate. At the same time, if you come with trying to request cash in advance terms, this won't be also helpful to your business unless your product is so hyper demanded, so you can afford it. But we don't discuss here, because credit management in the exclusive credit situation is quite simple. You set the terms you believe is correct. You're allowed to discuss them, and and you just use that. However, so you need to come with adequate terms, which will be something close to that range of payment term. So approach I share and share in my courses is quite simple. The foundation of that it looks quite simple. We compare credit demand, which is based on sales and on the payment term. We compare one with credit worthiness, which is in general assessment of risk of a customer reflected in money. So we compare money to money. Like, in order to have business with this customer, we need to provide them with a credit limit of 1 million. Then their credit worthiness is 500,000. Then we compare them. We see that, one is bigger than another one. Then we decide what to do with the difference. We can accept that difference. We can reject that difference. We can cover it with the trade credit security, and so on and so forth. It all depends on the situation. So there is the process I can propose to get I can propose to get to this, to get optimal terms of credit, but there is no one unique recipe to get that. In general, because in terms of documentation, it depends on the local market, to answer your question properly, because a lot will be dependent whether or not this is the one customer in the market we are operating. If we are in domestic credit or we are in export credit, and so on and so forth, then the number of documents and types of documents will be different. In terms of components, I can tell you that we need to have KYC as the first one. Then just as normal KYC as it is done by a bank, you simply copy. You may even simply use that KYC process from bank, again, if your business permits. Because if you are in a business where you got, like some companies here in the TIC market, where they got 500,000 around the globe, doing KYC on every of them the same way as it is done with the bank when they grant credit might not be will be too time consuming, but you can always adapt some. So KYC one, then assessment or evaluation of credit worthiness. So you need to define the credit worthiness. Then third step will be defining the range of optimal credit terms. You can watch the process a little bit on our YouTube channel. It is there. There is a master class dedicated to optimal credit term. Then you, using credit term as sales focused, you got credit demand. This is already fourth step. Then you compare credit demand and credit worthiness and see what is the relationship between them. You understand the potential risk exposure, and then you take a decision what to do with the risk exposure. you can either cover it with your with trade credit security if it is workable option. And again, you accept, you reject, or you just hedge, simply booking the bad debts provision from the very beginning. And somewhere in parallel to that, there is another step. You go to customer for negotiation and you really negotiate credit terms. And important step here is this negotiation must be aligned with the customer. So you don't have that discrepancy in understanding of payment term, of credit limit, of security requirement, because too often companies believe that 60 days payment term is equally understood by everybody, which is very far from being the case. I had a case where, in request for credit, it was written 90 days. 90 days payment term is 90 days, just like this. And everybody within the company assumed that this was 90 calendar days, which is like general understanding, where the customer and the contract signed with the customer, delivery contract with the customer, was expressly saying that this means 90 working days upon delivery and inspection, which in practice means slightly above 180 days. So that last stage is extremely important. So when you onboard new customer, whatever stages you did before, like you really did KYC or you didn't do whatever time frame you had and so on and so forth, but above all, you need to align, you need to have common understanding of terms by the three parties: credit management, sales, and the customer themselves, in order to prevent dramatic issues afterwards. Because then you will have to collect, and then when too many times credit teams and even business owners or many other people, they call customers, say you didn't pay us, then you understand it. And they do that just to understand that customer didn't pay because goods were not delivered, because two companies or supplier and the buyer understand payment term differently, and so on and so forth. All the possible issues which we could put under the topic disputes. And based on my observations, best way to reduce overdue is to remove disputes, is to resolve disputes before the due date. And best way for not having the disputes is to clarify payment terms with your customer before the first shipment. Again, I hope I've answered it. If you have further questions, please continue. We still have a bit of time to answer. Anash, is the collection effectiveness index report helping? There is no yes or no answer. Everything depends on your current stage of the situation. That's one thing. And second thing, it depends on the level of development of your credit function at the present moment of time. You see, if you concentrate on the collection effectiveness, having significant part of overdue in your portfolio, so when you try to reduce your overdue, and then when you understand that bigger part of work is collecting cash, and this is the task of the top priority, Then collection effectiveness, which helps you to allocate resources properly, will be of help. But if you are, yes, the session will be recorded, so you will see it. But in some different situation, collection effectiveness won't be correct. So, Vanessa, I do see your questions, and I am coming to it. Thank you very much for the presentation. How do you manage it when client decline our request to get financial statement? It's a great question. And this is the issue many colleagues are facing. So, first stage is to ask second time. There are parts in the world where the exchange of financial statements are not a part of the local customs of doing credit management and business as it is. One of them is Middle East. There are parts of the world like Switzerland, I give you an example, like United States, where legislation permits companies not to share their financial statements. For instance, financial statements of private company in the United States or private company in Switzerland is really crucial to, is the task which nearly impossible to do. But you can try to ask your customer and saying that we are providing you with credit. One of the best examples I had in my corporate life is when we simply sent a message to, we didn't have financials from one of our customers in the Middle East. But we said we are considering, because we need to increase your credit limit, and we are considering either to increase our demand for the bank guarantee, or we need to see your financial statements because we need to take a decision. Can you please help us? And I received financial statements next day. I don't believe this is the system, but when you knock on the door, there is always a probability that the door will be open. Then the door opens. Another way, if customer is not happy to provide you with financial statements, you might try to get them elsewhere, for instance, from credit report. Again, this is subject to a specific country and availability of data, but in my practice, I've seen many times when the credit report provided me with financial statements where customer refused to share them with us. Again, with all the potential flows of financial statements as well. If you don't have financial statements, if you let me to share with you one example. Zero credit, having no financial statements, having no financial disclosure, you can only say that the credit worthiness of customer is zero, because you have no support. You have no supporting documentation or any sort of basis to say that the credit worthiness of this customer is above zero. But at the same time, assessment of credit worthiness is not a credit decision. So you can still provide customer with credit because of business needs, but you should not lie to yourself and to your own management trying to say that, okay, customer is credit worthy because customer is important. No, this is not the case. Importance of customer is one part of the equation. Credit worthiness is another part. That's why we combine credit demand and credit worthiness. Vanessa, if you need deeper details, please don't hesitate to ask. Let me see if we have for other questions. Evgeny, yes, thank you very much, Evgeny. I think it's not that serious. It's just my nose, unfortunately. So if you have any further questions, my pleasure, Vanessa. I am helpful. I'm very happy to be helpful. Uh, how to manage strategic client pay us only based on their own terms, meaning example, we give them 30 days term, but based on their own cycle, they are within 50 and 60 days. This is exactly this is right. I mean, great example of what I said above. It's a credit terms alignment. Because my first question to you would be, what is written in the contract, and how you define the payment terms with the customer before signing the contract. Because you see, uh, normally the written contract with the customer, or even not written, even if the contract is invoice, uh, you really need to align with the customer what they understand under the payment terms. And if the difference is so dramatic, well, you can either live with what is going on or you change your payment terms. Because if a strategic client pays you in 50 days, this does not mean you will stop shipments to them. I don't believe you will be, because this is dramatic impact on the business. And if the customer pays you anyway in the 50 days or in the 60 days, what's the reason of having 30 days in your reporting or in your contract or in whatever? You need to ask yourself why you continue to consider that 30 days. Why you continue to have this overdue. There might be reasons to continue to do that, but you need to be clear that you decide, okay, yeah, I do believe, so we as a company do believe it would be better to have overdue with this customer, so we can use this as argument in the negotiation, because here is written contract, here is 30 days, but you pay us late there for 1, 2, 3, 4, 5, 6 hour requirements. Or you need to adapt your understanding of payment terms to what's going on. The situation between the two, I mean, each couple is unique. Each one couple is unique. This is about relationship, and business is sort of relationship. So relationship between customer and supplier is unique to this pair of customer and a supplier. And our job is to make sure our sales are profitable, and it is to make sure we got cash on the time. If you allow me to get ourselves into a bit of ideology, I can tell you that whatever maybe negative or drastic would sound like, business does not need credit managers. Business needs customers who buy goods, pay for them on time, and order again. And we as credit managers are supposed to stand in the center of this cycle and help company to organize that. So, and this like order, buy, pay, order, buy, pay, order, buy, pay, order, is supposed to happen with our minimum interruption, with our minimum introduction. The good job of credit management is to be seamless, or let's say as seamless as possible. So this supposed to spin without us, and we need to look forward and see what are the potential interruptions, what are the potential breaks to this process. So we foresee them and we remove them on earlier stages before this touches the business. Just like that. So just like in mathematics, in some equations, we've got two solutions. So when customer doesn't pay us on time, this might be an answer that they might be in financial problem, or our terms are already inadequate, and we need to check both versions. Thank you, Vanessa. Thank you very much for joining us. We still got maybe 2-3 minutes for a question if you have it. Otherwise, I will see you on the next masterclass. And Shibani, how can we ensure payment and recover outstanding amount from client effectively? You see, partially I just answered this question, Shibani. Yes, you see, we really need to make our, let me show you. I already explained that cycle of order, payment, and of purchasing, payment, and order. One of the captain of credit industry, Abe Vockenberg Sanchez, once defined the whole credit management in the shortest number of words. He said, "Keep them buying and keep them paying." So, what is the sense of that phrase? If we want our customers to pay us on time, and we need to prevent our efforts to collect, because every collection effort is a cost for us, is cost for the company. So instead of collecting money, and we have to collect, we have to be able to collect, and from time to time we need to collect. If there is already an overdue, we need to make sure we collect it. There are no two ideas about that. There's only one idea. Overdue must be collected, but main job is to be done not on the main focus should not be done on the collection of overdue. It should be done much more earlier. So we need to, and company found the customer, somebody who wants to buy, or who believes that our goods or our services or our product will satisfy their needs, whatever they are. Then we need to understand what would be we need to look at them. We need to understand who they are. We need to do know your customer procedure. We need to assess, evaluate their creditworthiness. Then we understand what is the potential volume. So we need to take all these stages, to go through all these stages, and we need to find optimal terms. If our terms are optimal, terms which will allow them to buy, pay, and order again, pay on time and order again, adequate terms, then we need to see how these terms perform in practice. So then, if they perform, everything's okay. If they don't perform, we need to find a solution how to make them adequate again. How can we adjust them? And we need to foresee, like, whether or not our credit limit still corresponds to the volume of this customer, whether or not our payment terms are still in line with the market, with our business, with our customers' business, whether or not both credit limit and payment terms are aligned to each other and correspond to the credit worthiness of this customer. The same story, we need to involve security requirement, and so on and so forth. And then, yes, the better we do this job on the earlier stages, the less collection efforts we have to perform, and the less expensive our credit function is for the business. And well, ensuring of timely payments, generally speaking, we can name the whole credit function as a preventive collection. You need to, so to answer that or to summarize what I said above properly, we need to make a systematic, we need to continue this systematic work about assurance of timely payments. And there is surely more than one, or many different ways to do that. It's a question, we need to build an effective credit function which ensures these timely payments. And yes, this is not that simple to do, as simple as it might look like, but that's what we do, for instance, in credit engineering, because we are helping companies to architect their credit function to make sure that it is as effective as possible. Okay, any let me see if we have any other questions, and let's wrap up for today. Vagela, if I pronounce your name correctly, this is like many times, even though terms have been agreed on, there may still be delays for whatsoever reason. That's they will be. But here, like if you did everything, so let's assume your credit terms are adequate to business, and they are properly aligned, and everything is done, and customer don't pay. Just if we take that last stage, then yes, you have to make sure customers respect your credit term. If you did one important reservation here. Please never judge overdue by its amount until you know reasons for non-payment. So whatsoever reason, this could be like, if there are disputes, you need to exclude them, because that's impossible, really nearly impossible to collect your money if your company didn't perform your part of the contract. If there is dispute in terms of quality, time of delivery, so on and so forth, it's again whatsoever reason. Yeah. Then second thing, you need to understand why they don't pay. So what is the real reason for non-payment? And if, for instance, they simply don't pay just because they could, then it's again question to you. Why you allow them not to pay, or to delay payments? Your reputation and your position supposed to be like, you are not the company whose payments could be just postponed for nothing with no consequences. We will have later on, I hope this year, because the plan for this year will be different, maybe later on. And that's what we learned, by the way, in our Deep CM course, which, let me announce, starts on May 6th. So if you want to have vast majority of answers about credit management, please join us. So one of the simple rules, one of the 5 simple rules that to ensure customer payments is that customer clearly understands what amount they should pay, then for what or why they should pay. Then that's the piece of information, when they should pay. So it should be really the specific date when they should pay. And finally, what's going to happen to them, or what's going to happen to your relations if they don't pay? So you need to work with your customers so they understand these four simple things. If they don't understand, I've seen in my life so many dramatic examples, like customer, when they receive goods from the supplier, they have no idea when they have to pay for it. Just like this. In this case, no wonder this company has significant amount in overdue in areas. So reasons for overdue is different, but you need to work with all of them. Our job in credit management and even in collection is to remove obstacles on the way, or from the way of cash from customer to our bank account. So we are removing obstacles in a systematic way. So if your customers don't pay, you need to understand why they don't pay, and then work with that. Well, ladies and gentlemen, thank you very much for being with me today. No, one more question I didn't answer, and this will be the last one. How do we deal with the client in case they are in financial crisis? It's really great question. And it doesn't have one simple or one simplistic recipe. But let me take you back to the holistic credit management theory, or like holistic credit management approach. First of all, we need to distinguish, and we need to understand whether or not this is still customer or a debtor. And the difference between, the bigger part of difference between the two is actually perspective of cooperation. Meaning that if there is no perspective of cooperation, you don't see this company as your future client, you don't see any future benefits with dealing with them, they are just a debtor. You need to find a way to collect cash and say goodbye to them forever. If there is still a perspective of the cooperation, you can see them as your customer in some future time after the crisis, you need to continue to stay with them. It's nearly the first proverb I've learned since I started to learn English. Friend in need is a friend indeed. Again, this also will be subject to what resources you have to support them, and whether or not these resources are enough to support them. Yeah, because you might continue to provide them with credit terms and to help them to survive as a business, but if any other creditor will pull away their credit facility and they go bankrupt, then what? So you need to be clear about all the future scenarios, but your intention to help supposed to be like first reaction, again, as long as they are, as you still see them as a customer. I helped quite numerous clients when I was a corporate credit controller, but again, sometimes in couple of cases, this was really like, the thing which it was just waste of resources, because we didn't have as big business as we wanted, and so on and so on. But okay, we've tried. It's anyway, it's a question of decision. What you can do, you can restructure You can, when we get to the specific tools, you can restructure the outstanding, you can extend credit terms, you can provide them with a bigger credit limit. However, this supposed to come with a certain degree of control. So your customer is transparent with you, and they are in contact with you, and they are explaining you what's going on, what's the situation is changing. It is difficult. It is difficult, but uh, on the other side, if you simply cancel your credit facility with the customer, and customer will survive. Just like saying, if you were not present at the fight, don't expect invitation for the party. It will be quite difficult for you to come back their supplier again. I've seen a couple of examples where suppliers withdraw their credit facility, but then after survival or after customers' recovery, they found other friends, and they will never work with you. It's always a question of choice. It's my time to thank you very much for coming and being with me today. Uh, just couple of announcements in the end. We continue uh, with our series of crediting, and in April and in May we will have views on different countries and credit management with them. If you follow us, don't forget that on April 4th we will have Edward Altman himself, and this is the person from books of whom I've read most part I know about credit risk. It's a person who did Altman Z score, and he will come together with Dr. Gabriele Sabata, and we will be discussing credit scoring and credit risk assessment in the area of small and medium-sized enterprises. It's extremely interesting topic, but to me, it's a great thing. We will have a chance to speak with Edward Altman. If you wish to learn about credit management in depth, about holistic credit management, on May 4th, we start our next flow of credit and accounts receivables management diploma course. So if you wish to join us, please register on creditengineering.com. Otherwise, if you didn't find the link for registration, send me a direct message or put one in the comments. For now, I thank you very much for coming, for staying, for being that extremely active, and I wish you to have highest possible sales, lowest possible losses, or as we can say it in French, bon crédit. See you around, and see you next on our next event. Bye bye.